Okay, and I have my soundboard back up, so we're gonna do the startup sound. Okay, so something I like to ask is like, asking about new company that we're joining. So the LTV to CAC, we'll explain what this is. We'll also talk about ARR. We'll talk about maybe payback period. Payback period. Anything else that people know, like valuation, I guess, runway, burn, anything else that people often wonder about and never asked? Churn. Thanks, Julius. Good question. Yeah, I heard someone ask. Yeah.
Well, I'm kind of new to all of this. Where I don't want to kind of take up the time with like, I'm new. Can you just explain everything? But like, where would I go to kind of like get a refresher on this stuff? Because like,
so I don't know, because I've been doing this for like 10 years at this point. So yeah, Jose says the internet. Okay, so there's the equity side. So what's the equity comp thing that people keep sending around? You know, does anyone know what I'm talking about? The manual, equity compensation, the manual of compound. There's the Holloway guide to equity compensation. Like some of this is going to be good for understanding startup finance. And keep in mind that this is very American focused, but most tech companies are sort of American style, even if you're not formally in the US. So there's compound. All right, let's just does everyone have like resources that they want to throw up? Resources. Let's just throw compound here. Let's throw the Holloway guide. Investopedia is actually decent. Like even though it's kind of like a very old site, a very sort of normie site, but I do recommend it for the definition. So let's just plug in ARR, Investopedia. Okay, that's a terrible definition of ARR. I take that back. All right, this is better. So
Investopedia is my life, like my finance life. I thought Investopedia was gonna be a useful resource, and once I actually started doing something in finance, I realized Investopedia is like pandering.
Got it. Julius, you sound like you know a lot, Julius. Growth.
Oh,
okay.
It's picking up from here and there.
Okay. All right. Okay, so let me kind of phrase it a few ways. So this is obviously very startups focused. So let's declare our biases, right? Biases are US focused, maybe startup B or sort of big startup, big co, big tech co. I think that should be fine. SaaS is another, software as a service is another bias. So the alternatives to SaaS are, let's say, e-commerce, ad, so not e-commerce, not ad-driven, not, what else? What other sort of platforms are there? Whatever.
Not marketplace?
Yeah, not marketplace. So this actually, I guess, segues into something that we're going to cover next week, which is the business of software. And we have a few lists of analysis of business models where we have agencies, advertising, subscription. This is the vast majority of how stuff is priced, that you can start analyzing things that way. Marketplaces and gaming. So I split up a bunch of these things, other type of valuations. Yeah, so basically we're just saying we're not covering any of those, right? We're saying SaaS or infrastructure, because I feel like I've spent enough time in infrastructure that I can give you some idea. Anyway, so yeah, we're not talking about all those other things, right? Okay, so let me give you an example of why valuation matters. This is all improvised, by the way, so just kind of roll with me. But the thing from Gergely was very eye-opening for a lot of people. Right. So he says, Uber was founded in 2009, Datadog founded in 2010. 7 years ago, Uber was valued at $62 billion, Datadog at $150 million. 7 years later, Uber is valued at $63 billion, so no change, and Datadog at $43 billion. So what is that? 43,000 divided by 130. That is a 330 times increase. So whatever equity that you got, multiplied by 330 times, just as an employee of Datadog. So keep this in mind. They were founded the same year, but based on how the business is going, can change your compensation very heavily, regardless of your coding. I mean, obviously your coding like affects it, but obviously deciding which to join, let's say at the 7 year ago point, it was a very significant decision. So I really like this this comment. So I'll just kind of paste it in here if you want to see the replies. And then the other thing that I would also refer you to is an analysis of like the different types of ACVs. So we'll talk about this. Notice how often I use Google as my personal search engine. Okay, so different types of companies feel very different. So let's say Confluent, which is the sort of enterprise Kafka company. They have an average contract value of $160,000, which means the average customer pays them $160,000 a year, right? Accordingly, they have there are fewer customers. They have only 2,500 customers at IPO, whereas Atlassian, which is the makers of Jira, has an average contract value of $5,000 per year, and they have like 20 times more customers than Confluent. And all of these are, valuable companies. I think maybe Atlassian is slightly more valuable now, but they IPO'd earlier. But they're all like tens of billions of dollars in public valuation when they IPO'd. So I think they're just like really good ideas of when you're joining a startup, do you see this company going to something like this? Because that's how you get paid. Everything else is just like made up monopoly money. So you really have to kind of figure out like the question of like this. So and this is real math, right? Like I can literally take this and say, okay, 51,000 times $5,000 ACV, so 51,123 times $5,000 ACV. They're making $255 million a year as revenue. That's not going to be the exact revenue. Everyone has some kind of services business. Sometimes the ACV has some like weird fudge to it. We'll talk about that. But roughly, it's going to be in the order of magnitude of $255 million a year. And then you take a standard, so that's your revenue. And then what's a standard price to sales ratio at IPO? Let's say between 10 and 30, depending on where you are in the public market. So if it's 10 times sales, it's $2.5 billion at IPO. If it's 30, it's 7.5, right? So it gives you a rough math of like what kind of valuation you're joining versus where you might be exiting, and the main drivers that you sort of break down in order to get there. So that's the kind of the relationship between average recurring revenue and average contract value. Does anyone have questions on that? I feel like I'm lecturing. This is meant to have a discussion. Yeah, Chad or Omar.
Oh, go ahead first.
Yeah, Omar.
Yeah, are these numbers public? Can you find out what the company?
Yeah, I pulled them all from their public filings.
Okay, so where do you pull these numbers from? Like,
yeah, sure. Just go Confluent S1, and then you just kind of Google it. ACV. Do they have ACV? No. Okay, so sometimes you can sort of back it up, but no, I'm pretty sure I pulled a real contract value here, but oh, here, look. They say there are 2,500 customers. Then they'll tell you some of the higher ACVs, right? So I just told you that their average ACV is 160K, but that's an average, right? And so they're going to have some people higher, some people lower. So it also matters, can you reach 100K? Can you reach 1 million? And do you have like enough runway such that this ACV starts to trend up over time? And we'll talk about that as a net dollar retention. But yeah, you can just kind of pull it off from here. I don't know what exactly I searched, but it's inside all the S1s when they file for IPO. Does that help, Omar?
Yes, thank you.
Who's next, Chad or Antonio?
Yeah. So in terms of like say you're joining or say a brand new startup, like
Yeah,
they're still kind of figuring things out.
yeah.
They kind of approach you with like, hey, we want you to come on your team. How do you kind of leverage, because obviously this wouldn't exist either nearly as much, or they don't have customers or stuff like
Absolutely.
that. How do you make decisions on those that kind of lack of data? Obviously you're kind of betting, but
You're 100% betting. So it depends on what stage you are. Where the hell did, oh God, okay. I okay, I guess this is it. Okay, no, I don't like this. I should change the canonical link. Give me 1 second. So this is the resource that I've been maintaining for exactly this question, because the stage that you are at really matters. So let's say you have series A. No, this is not the one. Just the average money raise. I'll just put this in here for you to read because it's a very long read now. But it's kind of my brain dump of like anything I know about fundraising. Okay, yeah, here we go. So depends where you are. So sometimes it's just like 2 people and like a 100-line script or a PowerPoint slideshow, right? That's the sort of angel pre-seed stage. That's very, very young. With seed stage, you have kind of like a working MVP and some design partners, some employees maybe. And then Series A, you have, this is your first price round where you're actually on the VC clock, and you have a working product, some loyal users, and just it's more and more developed over time. So I don't know, Chad, if you have a specific idea what stage, how rough it is. And if this may be a bit way too early for you. A lot of people consider Series B and C still very early stage if they're not used to startups. And I have definitely gone there. Like when I moved from like a very established like 2,000 person company to my first Series B startup, that to me, I was like, wow, this is so risky. Now, like, like it's a joke. Like by the time you're Series B, you already have what they call product market fit, which is like some clear evidence that you're not going to be worth zero. And that's the best way I can put it.
so the company's definitely pre-seed. Like, in fact, when I was talking to the person, that's literally the phrase they used.
Okay, all right, yeah, it's good. It's good to classify the type of risk, right? And there's also probabilities of failure for each of these. I think there's charts out there. Where is it? This, let's say every single stage, the probability of failure goes down by 30%, something like that. And it's compound. So let's say from here to here, like it's like 70% that's like 30% that's likely to fail, and then from here to here another 30%, something like that. But it's super rough, and it's very what I call ergodic. Like it's a non ergodic process. Like in other words, like some companies will be successes from start to finish. Some companies are kind of doomed from the outset. So it's not like you can suddenly be rescued just by a toss of the dice. Like there's a lot of humanity and strategy in it. Antonio and then Max. For Max asked a question. What was temporal when I joined? It was Series A, and then I saw it through the Series B. Series A valuation was, let's say, 150 million. Series B was 1.5 billion. And Antonio. Antonio might have a connection issue.
I know. Yeah, I gotcha. It's a very similar question to Chad actually, because like.
Oh boy. Okay, and so it seems like your audio is cutting in.
Yeah, it's because I'm on AirPods, and as soon as I touch them, they just decide of unmuting or muting. So, like in terms of like when it's similar to Chad's question in terms of like when you decide to join a startup that doesn't have all of this documentation or all of these data like publicly out, like what would be kind of similar patterns of like understanding where can be the growth without having access to as significantly open financial data.
You have to ask them, and they should be comfortable. They should be comfortable telling you, because you're betting your life and your time and your money with them, right? So that's why I say, like, are you able to ask the right questions in order to get interesting answers, right? So and then are you able to evaluate the answers? Like, I think this is a part of like startup life that maybe people haven't been trained on, and they kind of have to pick it up as they go along. So it's pretty interesting. Okay, Max or Chad, you still have your hands up. Oh, Chad.
Chad, go first if you want. No problem.
No, go ahead. Go ahead.
You sure? Okay.
Yeah.
Okay. No, I was just saying, like, because when I joined this company, I think they're Series C now, and I was pretty happy that they closed the Series C quite a bit ago.
I have to go, buddy. I'm gonna miss you.
Sorry. Let me try to mute Antonio. He's not managing his mutes. Okay. Hey, yeah,
right.
Sorry. Yeah, you say you joined at Series C?
I think so. Yeah, it's a Series C at this point, and I was pretty happy that they closed it pretty recently.
Cool.
Recently, like this. Yeah, no, I was really happy because in the end, the stock market has been tanking, and I was following regularly a bit on Twitter.
Yeah.
And like his thesis is a bit that now that the stock market is tanking, all of those kind of startups that have not yet IPO'd, they're going to have it's going to be much more difficult to raise money. And so I thought that's really interesting, and that's really I was really lucky to land in this place right now because they have secured the funding kind of already.
Good. Congrats. That's good timing.
Yeah.
I think good startups will always be able to raise. It's just about whether you want to raise at a crazy valuation by people who are FOMOing, and they're just kind of throwing money at you. So for example, I know, at this point, I know a few venture capitalists, and they're honest enough to tell me that during the peak, let's say the peak of the tech boom was in November 2021. They went and invested in companies. Like, let's say they'll have an initial offer to invest in a company, and this company they wanted to invest at a $750 million valuation, but it was so competitive that they ended up investing at a $1.5 billion valuation. In other words, the original offer was 50% of where the thing finally got done. So I think it's a pretty similar dynamic to like a housing market, except that imagine if instead of millions of houses on the market, there's only every year there's maybe only like 10 or 20 unicorns. So you have to get into one of those. Chad.
Yeah.
So I guess this isn't directly a finance question, more of a startup question, but like, say, so I don't have enough information to make an assessment about whether or not the company will do well, but I know that my career will grow by joining the startup, regardless of whether the company fails or not. Is even that a good decision in the first place?
Yeah, non-financial factors. So career growth. That's absolutely correct. So especially in startups, there is nobody blames you if the company that you worked at happened to fail, right? It's not your fault. And so if it gets you into if it gets you more skills, if it gets you into a domain that you want, and if the company fails, like, people will happily hire you. And in fact, like, that's a really good reason to leave a company, because it's not working. The company itself is not working out. People are they don't hold it against you. So yeah, like, in one sense, you are absolutely not an investor, right? Like, you're selling your time. You're an employee. You hopefully learn and grow and contribute to the company, but you can leave whenever you want. So in that sense, you're not locked in forever. You're not investing your whole life in this thing, and that's really great. I think someone's editing. Cool. All right. Okay. Let me sort of go through. So I talked about ARR. So ARR is annual recurring revenue, and this is very much a SaaS, a software as a service or infrastructure sort of type of meaning, which is the default assumption is that the money that you make this year will come back again next year. So it's very different from, say, an info products business, kind of like this one. So like coding career, this community or a book or whatever, is not a recurring revenue business. It's like a one-off thing. Yes, also annualized run rate. Jose, actually, you probably have dealt with this a bit more than me. You wanna talk about that? I mean, I can also.
No, that
I like new voices.
Sorry.
Oh, okay.
A big problem is that people quote ARR and it's not recurring. So it's not the same thing. Like when you see the revenue and it doesn't look consistent, it's sort of like a play on metrics. Like they say ARR just to quote like an annualized number, but it's not like the same stable cash flow coming in.
Correct. So maybe I'll put it this way, right? Let's talk about Zoom pricing. So Zoom has ARR. Let's see, like that, right? So we know that when someone signs up for like 350 a year per user, and there's like 50 users, that is whatever 50 times 350. I can't do that. 17.5K a year. That is kind of recurring revenue. Sometimes it's I don't know. So there's a few tricks that you can play, right? One is the annualization. So let's say you got a big month from some customer, and then they'll be like, oh, okay, like our annualized rate is like this times 12, right? Like which is a trick that some people can play, but you just know that it's a one-off. So so that's definitely something you should not count against. And then the other thing that is also tricky is sort of usage-based billing. So that's another trend that is coming up. In other words, there's no such thing as like a recurring. This is a recurring subscription, right? Where whether or not you use, no matter how much of it you use, how many calls you make, you're still going to be charged 350. But a lot of businesses, especially infrastructure businesses, are moving towards usage-based billing. So, I wrote a whole thing about this, and I think it's definitely a trending topic, where let's say they'll sell storage per gigabyte, and it's just based on how much storage you use. Yes, that tends to trend up over time, but it could also go down, and you're not the customer's locked in. The customer's not locked in to some amount of spend. It just is some level of spend that hopefully goes up over time, and it's like kind of not recurring, but kind of is. So the industry hasn't really developed a term for usage-based billing yet. We still call it ARR today, but it's not exactly correct in calling it ARR. Anyway, but those are the nuances, right? The most important thing is what percent is professional services. So every company has some of this, and professional services are often like consulting, basically like how much human labor are you selling versus machines and software doing the work. And sometimes it's 0, sometimes it's 50%, sometimes 70%. It can go very high. Because most companies, especially enterprises, want some kind of professional services to do the work for them, to do integration work or whatever. And that is not recurring. That is a much lower margin business. So we should talk about margin as well. So margin. So margin is basically, there's two types of margin: gross margin, and there's a profit margin. The business school types will say like EBITDA margin, but it doesn't really matter once you get to some amount of so accounting for fixed costs. So gross margin, gross margin basically takes into account the variable cost of goods. Like let's just say the more services you provide, the more like bandwidth you consume. I don't know what other cost of goods. Like these can be very high. It can be like 90-something% in the case of Google, and it can go all the way down to, I don't know, 60% in the case of infrastructure companies, and then it can go all the way down to maybe depends how you count it, between 5 and 30% for marketplace or sort of content-heavy businesses where you have to do revenue share with your content creators. So the gross margin is very high, but that actually gives that actually matters a lot as to the quality of the revenue, right? There's such a thing as the quality. In other words, like if you're selling things at negative margins, obviously you can go down to negative margin businesses where you're literally taking something that's worth worth $1 and selling them for 50 cents. Those are subsidizing businesses. So in other words, for example, you can see like Uber in the early days during this, where in order to just capture the market and develop the market, the customer habit, you heavily subsidize the business so that everyone uses you, and then you slowly take the subsidies off. And it remains to be seen how loyal the customer is once you take the subsidies off, and that's a bet. But yeah, does anyone have questions about margin stuff? Okay. Let me do a side. I'll do one digression on income statements, and then because I feel like this is the best way to explain margins. All right, let's look at this income statement. How do I do this? All right. Okay. Where's the right image? Antonio says, is it like the Uber Pass that they had in San Francisco in 2027? I guess. Yeah, well, no, that is a sort of pricing model thing. That's not kind of like an unlimited subscription model, which is slightly different. For Uber, they were literally subsidizing every ride, especially in New York, to get off the ground. All right, so this is an example of like an income statement that you typically see. So the top line we just talked about, which is revenues, and then the middle line is cost of goods sold. This should be the variable cost, which is like more or less as revenue grows, the cost of goods sold is going to grow in some kind of fixed proportion. It's never really fixed, but it's kind of in line. You can see in this business, the cost of goods sold is not quite growing as fast as the revenue, which is a very good thing, which means they're getting economies of scale. But in theory, the cost of goods sold should be quite varied with revenue. Gross profit is so gross margin is gross profit divided by revenue, right? So let's say revenue was 70 divided by 108 in this. So that was 60% gross margins in 2014, and that went to 94 divided by 150. There was 63%. So gross margins improved from 60 to 63%, right? And that just makes the fundamental profitability of the business much better down the line. Below the gross margin line, there is marketing, general administrative, depreciation if you have a lot of capital expense, and then interest if you borrow money, and that adds into total expenses, and that gets you sort of your net profitability. Taxes are not really within your control, so people just kind of look here as the EBITDA that line, and that's kind of the operating profit of the company. So you can still calculate, let's say 16%, 16,000 divided by 11, 110,000. So this company has an EBITDA margin or profit margin of 15%, something like that, right? And then you can go here and you go 39 divided by 150. This company has 26 percent EBITDA margin after this 4-year period. So in other words, the margins of this business has grown a lot, and it's growing. The profitability of the company is actually growing much faster than the revenue, and you can sort of break down the margins this way. Max.
Yeah. So what would be the equivalent of cost of goods sold in a SaaS business?
Yeah. So literally like your AWS costs often, number of servers, amount of bandwidth that you're paying, amount of database storage that you're paying for, that kind of thing. Very, very, very much like the infrastructure cost. Whatever goes up, the more users you have. The rest, maybe it's better to define it as the opposite of whatever's in here, which is the sort of SG&A line that people talk about. So this is sales, or we kind of lump sales and marketing together, even though they're a little bit different. There's G&A, so just like the administrative overhead. And then there's often R&D, which actually a lot of software engineers are placed in, right? So we're like, our salaries actually paid out of this R&D cost center. Sometimes they're capitalized, but often they're just paid out, because it's often like to pay the least amount of taxes, you want to goal seek this number to 0 or negative. Okay, I see. I think you can actually even claim some tax credits if you're negative. I'm not even sure about how that works, but leave that to the accountants. But basically, this is the amount of money you're going to spend anyway, whether or not you had increasing or decreasing revenue in that period. Right? Because you already plan to spend this. This is like your headquarters costs, like your I don't know, your janitors, or I don't know, your janitors and software engineers, whatever, your staff, right? Like, and then the existing marketing expense that you want to build for the long term. Cool, cash flow gains. Ooh, so yeah, I don't know about the goal seek thing as much. Honestly, it's very determined by tax strategy, much more than accounting principles. All right, cool. I'll just kind of stick this in here, but just don't concern yourself too much with them. Like, you can pay someone for this. It's a very commoditized thing. Don't really worry about it. In fact, I feel like this is pretty much the max you want to know about gross margin. Just figure out just figure out gross margin. Don't worry about profit margin, because especially at a startup, they're not going to make any profit anyway, and it's going to change a lot. And it's very much within your control how much you want to grow, right? Like, I think the business is going to go on fire. I'm going to rapidly increase my R&D expense. I'm going to hire a whole bunch of people now in anticipation of a big growth period, right? And so that's going to drive my earnings in the short term down, but hopefully earnings in the long term up. And you just don't have visibility on that. So that, like, all this is just kind of like the investor's concern. You should, but just based on for the health of the business, you should kind of have a good sense of what the gross profit is. So for example, at a previous company that I had, we were targeting 60% gross margin, and we asked an advisor, and he was like, that's a terrible margin for infrastructure business. He wanted us to be closer to like 70 or 80%. And so we changed our pricing in response to that. But you should check, roughly know the economics. Like, why is Google one of the best businesses of all time? They have 90-something% gross margin on the core search business. So yeah. All right, cool. Churn. So not everyone subscribes with you forever. So there's a churn and LTV. So it's going to link all these things together. So churn is the concept of like what % of your customers leave you every month, quarter, or year, right? So there's sort of monthly churn, quarterly, annual. What is good churn? What is bad churn? Does anyone know any churn numbers? I can give you my mental image, but I want to see if anyone has thought about churn.
20% is good, I think, right?
20% churn is good.
I think so. I don't know.
Is that annual or monthly, or what is this?
Annual, I would say.
No, okay. So in no universe is 20% churn good. So okay. Jose says 2% monthly. Yeah, I think that's decent. I think it could be better. I think there are guidelines out there that tell you something like like 0, like, and it depends on your category, right? So again, this is like I don't know. It really depends on your let's say B2C, B2B, B to SMB, or B to big enterprise. You can sort of break it down like that. B2C churn can be between 2 to 10% monthly. In other words, like, let me clarify how bad 10% monthly is. This means you churn through 120% of your customer base every year, right? So like it's really like you have a leaky bucket. Like, every customer that comes in leaves you within a few months, and that's really bad, because like you're gonna run out of people to try to draw in, and it's very expensive to acquire those customers. SMB also has a high churn rate, let's say like 1 to 5% or whatever, and then enterprise it's a bit lower, it's 0.5 to 3%, whatever. It's something like that. These are very, very bad numbers. I'm just going to give you a ballpark that there are different categories of churn, and how well you're doing depends on what category you're in. Chad.
Yeah, so I guess it's 2 questions. So say you have like a company that was it wasn't necessarily a business or anything, but obviously they kind of relate to these numbers. So like, say for instance, they had a high churn rate, but they weren't necessarily like a business, they weren't trying to make revenue, they were just existing, and then they're becoming a company, and then obviously one of the things that they want to do is to reduce their churn rate. Okay. Is that like something you should be worried about as like their kind of previous history? And then I guess the second question would be, does it also matter in terms of like their total number of kind of like not customers, but users. You know, like would the churn rate be, would it be better if like they suddenly got a lot more users and then the churn rate, like then you're more worried about that churn rate as opposed to, oh, they had a high churn rate but they had a small amount of users?
Right. So these are all good questions to ask when you join a company. You're starting to think about it right. You know what I mean? So there's no right or wrong answer. I would say, yeah, Jose, I'll get to the NDR thing in a bit. There's no right or wrong answer, but you know, you're now starting to think about the business model of your startup in a way that kind of relates to the accounting statement, right? Like, what are the drivers of this thing? What are drivers of this thing? Like, okay, like, is this a problem? If it is, let's talk about it. If it's not a problem, let's move on, right? And trying to figure out very quickly whether zero in on which part of this is a problem, or is this like the best business you've ever seen? And oh my God, I need to join right now, you know? So like those are the kinds of questions that are really useful. I will say that, yeah, oftentimes when you have a sudden influx of new users, your churn will tick up because a lot of these users are not the exact profile that you actually wanted. Let's say you suddenly got featured on Hacker News, featured on Oprah, featured on whatever, right? And there's a lot of new customers who've heard of you, trying you out, kicking the tires. You should expect a much higher churn from those people because they didn't come through the normal acquisition funnel. So they're not the normal profile. A lot of them are just going to be like, I don't get this, and you shouldn't worry about it, you know, because they're just a different cohort. They're a different audience type. But it's a good way to figure out like, okay, what was the special event here? Like that caused the bump. All right, I can ignore that for now. And then, you know, maybe if you're doing a financial model, which I have done for companies that I've joined, you can even say like, all right, assuming that, you know, this was a temporary bump, like what is the normalized rate of growth for this company? Oh, that's another good question. What is normal growth? I'm just going to feed this to you. So let's say a decent startup. So there's the startup growth curve, which is 3T2D, triple, double, which means the first, let's say like the year you hit your first million, you want to grow 1 million, 3 million, 9 million, 18, 36, something like that. That's a classic triple, double. It may extend more than that or below that. I actually have, so the founder of GitLab has a really good equation for this. May even have it saved. There you go. Okay, so this is Sid, the founder of GitLab, and his equation is it's T2D3. So 2 million, 2, 7, 16, 34, 17, 144. Around the $100 million mark is kind of like you're guaranteed to be unicorn at that stage. And so it's basically a question of how quickly should you grow there. And people have recommendations for how fast SaaS companies should grow. This is kind of like top tier, best of Silicon Valley. You will be a hot company if you follow this trajectory. In other words, it's roughly 13% month-over-month growth. Every single month you're growing by 13%. That is a hard thing to keep up over the course of 5 years or 6 years. And obviously that you know, as your base goes up, your growth rate goes down because it's just harder and harder to keep growing at the same percentage rate. Does that make sense for, I think it was Chad that asked this question about growth. Why did we talk about growth? I don't know. But anyway, growth is
no. Yeah. No, it's great. Like, I really appreciate all of it. Thank you so much.
No worries. I love talking about it too, as you can tell. All right, so there's the question of NDR. So this is related to growth. Some growth you get for free, especially in SaaS businesses, which is why people love SaaS businesses a lot. When do you get growth for free? When you get negative churn, right? And how, like, this concept of negative churn is really is honestly just like a marketing phrase. In other words, sorry, let me put this in. In other words, like, it's not really negative churn. It's just like expansion revenue. In other words, like, let's say, where's that Confluent CC? Let's the Confluent statement again. Let's say, you know, we have 560 customers paying us $100,000 a year. how like and then next year they pay us 200,000, and then the year after they pay us 400,000. The next year they pay us whatever, up to $1 million of revenue a year. That is negative churn through just their own growth in usage, right? Let's say, and this was very true at my previous company, where we would start in one team, and then the next year we would spread to 10 teams, we'll spread to 20 teams after that, and 30 teams after that. And so more and more users, they're going to pay you more and more just for the increased usage, right? So there's negative churn in the sense of like, it's just going to naturally grow by itself, even without your really asking or selling to new customers. It just is so organically growing within a company. A good negative churn, and there are benchmarks for this. I think it's like what okay is like 110, good is like 130, great is 150, and then Snowflake, which is regarded as one of the best businesses that has ever walk the face of the earth, is 180%. I definitely think that this is cohorted as well. So in other words, it's very common for businesses that have just started to have much higher churn. Like I think Temporal had like 200 to 300%. I'm expecting Temporal to 200 to 300%, but this is new. This is new money. It's not real because it just starts from a low base. Mature revenue has kind of more this kind of profile, and I think Sarah Go. Do you know Sarah Go, Jose?
I mean, wasn't she in your class?
She was in my class. Yeah, exactly. I think she gave me these numbers for NDR, so that's where I took them from. Yeah, I can't really find where she got it, but I think she talks about it. But these are the benchmarks that you kind of are shooting for. So not only are you trying to churn less, but within each account, you're trying to grow each of them naturally. Like, is your product just so inherently viral within the company that everyone's like telling their friends to use it, right? It's like, is it Figma, right? Like the more I use it, the more product-led growth like kind of drives the next user to just join naturally, and they're like, ah, crap, like we hit the usage limit again. Let's go pay for the next tier or whatever. Right? That is a very natural negative churn process. And if you're in this sort of very privileged like 200% mark, you're naturally growing like without any new customers, just the existing ones that you have, you're already growing at 100% a year, something like that. You know, like that is just a fantastic way to do startup growth. And there's a very famous essay by Paul Graham that always talks about startups equals growth. Like there's all these numbers that we talk about, like beyond anything else, you do need to figure out whether it can grow. So I'm just gonna put it in there as well, because it's really tempting to get really deep on some of these numbers and forget the big picture. The big picture is always, are you growing? Everything else, like growth, solves a lot of things, or buys you time at least, unless you're paying for that growth with negative margin. Okay, we talked about growth, talked about negative churn. One thing I wanted to mention before I left the churn discussion is LTV. Also, there's a concept between so let me give you some more terms to look up. So there's gross churn. This is the churn that cannot so what normal people consider churn, and then there's a sort of net dollar retention or negative churn. And that's the concept that we're trying to go after with this thing, which is a combination of amount of churn, but that is also replaced by the amount of expansion revenue that per account. Does anyone have a good chart for this? NDR negative churn. There's a lot of charts that are swimming in my head, but I don't have them ready. Let's just see who has like a nice chart. I don't know. I don't have one ready because I haven't really prepared to explain this, but maybe this one. Okay, you start out 100 a month. Let's say 50% is $50 lost to. Oh, okay. Let's say you start out like this. Oh crap. Maybe these guys are trying to explain it. Oh, all right. Here's a good resource. Oh, they explain 20 different types of ways to talk about revenue. Oh, fantastic. They also talk about constant currency. Okay. So maybe I'll just send you there. So I don't have to do this. It's a complicated, obviously when it comes to accounting, you have to be precise, and businesses are complex. So I think it's worth learning, but at the same time, just love this. Thanks, Jose. Thanks for your input, and see you next time. Chad?
Yeah, so I guess more kind of asking from the founder perspective, how much of this should you know before you walk into trying to do a startup? Because it feels like this is just not information that people would generally have walking in.
There's a range of answers ranging from 0 to you should know a little bit. You should know what the meanings of all these top level words are. You should not know the precise accounting definitions. I would, if you know, like as an investor, if you know what good means, so if you know what okay means and if you know what great is, then I trust you a lot more as a prospective business owner, because you just know, like off the top of your head, like what is achievable and where you want to be relative to that and what it takes to get there, right? Like it gives me a lot more confidence that you know how to run a business. Or am I going to have to teach a lot of that to you, or you're going to have to pick up along the job and I'm paying for your tuition? Yeah, Jay.
I have a question on from your experience. Could be so. This is all primarily the finance. This is what is the interaction of what's the role of a technical, like if you're in a startup, maybe you're one of the guys who is spending money on some things, or maybe if you're building product, like you're probably influencing some things here, like negative churn, like the product is like Snowflake's product is the one that is sort of causing negative churn, right? The usage-based billing. And how much of what are you drive? What is a tech person in a company? What are these? How do you? What variables can you influence? Does a tech guy influence? Like be it a tech manager. Like if you're in a startup, you're probably one among the 4 or 5, right? What numbers here can you is a tech person able to influence in a startup?
That's a great question. You have very little control on a quarter-to-quarter basis, but you have a lot of control on a year-to-year basis. You know what I mean? Like the tech choices that you make, like whether or not your architecture is scalable, is going to determine gross margin. Right? Like if the more scalable it is, the higher
expenses. It could be one of them, right?
Yeah.
Okay.
It also can determine profit margin if, like, in order to scale 10x, do you need to hire 2x more developers or 10x more developers or 20x more developers? Like how well can you support? Can your existing core team support massive scale, right? Like so WhatsApp acquisition. How many developers? I think they had like 13 developers. They had 35 engineers and supported 450 million users, right? Can your engineering team have this ratio of engineer to users? And if not, like, but look, it's not your ability. Like, this is the complex equation. It's not just like, did you make the right framework or language choice or anything like that? It's also like the use case, right? This is just chat, right? So like it's not as maybe intense as live streaming or whatever. But there's the opposite scenario where there's right now this very public debate. Twitter has 8,000 employees, and most people are pretty confident half of them are not doing anything. Right? This is not a joke. Like I've discussed this with a Twitter employee. And he's like, we just don't know which half.
Right. Yeah.
Which is ridiculous.
I think it's
eerie.
So I think this is the WhatsApp case is something that I aspire to be. Like I actively try to keep my team smaller, but it's like it's also depends on, it's a very good problem space that require, like the problem space that they have chosen doesn't require the team to scale.
Exactly.
Whereas if you if you have to serve customers, then like AWS professional services, it has to grow to somewhat.
Correct.
It shouldn't be linear, I suppose, right? Like if you want to contribute, it shouldn't be linear. Okay. And definitely having an understanding of these numbers, and is it always coming from the CEO as a mandate? Hey, you need to look at cutting costs, or you need to look at increasing numbers, or is it? I've not worked at a startup, it's why I have this curiosity now.
I see.
How does this, like, what is the dynamic like in startups? Where is it different people coming up with ideas to move these numbers, or is it usually the CEO and chief product officer, revenue officer thing, or they.
Yeah, mostly these kinds of decisions never reach the employee ranks. It's mostly leadership. And it's mostly the C team or the VP team, and that's it. And mostly like you'll do planning based on a number of things. You do planning on how ARR is doing. You try to get margins under control, but again, like I said, growth is more important than margins. As long as your unit economics are positive, fine, okay, the standards are pretty low here. You want to make sure, like, okay, churn is very important. Like if you have a high churn business, you don't have product market fit. And if you get it down to something enterprisey, then you can start to say like, okay, we have a very stable business on which to build and to pour fuel on the fire. I'll say like the most important thing planning wise for executives is runway. What headcount do I have? Because let's say I'll capitalize the average engineer between $150,000 a year, like fully loaded, all healthcare costs, all options, all whatever, to 300,000. I've seen this kind of range of numbers, right? So that gives me, let's say I raise, and I've done this calculation before, by the way. So let's say we raise $3 million. We need 10 engineers. So that is something like, I'm just going to take a midpoint, like $2 million a year. This is going to give us 1.5 years of runway. It was very super rough, right? Like that's kind of like that means that I only have 10 heads to play around with. Those are the really big moving pieces. Like plus minus a few $100K, don't really care. But like I have 10 heads, so I need to make the 10 best hires I can possibly make to achieve the next milestone for the next round of funding. That's kind of usually the calculation. Beyond that, like keep good enough on things like churn. Keep good enough on margin, and then the rest will sort itself out. So the most like sort of life-threatening business, there's a kind of like a hierarchy of needs, right? First of all, make sure you don't go out of business. Then second of all, work on the quality of your business, assuming that it's viable.
Yeah. Okay. And the 3 million is probably for all departments, the marketing, sales, and everything. You probably get 2 or 3 engineers.
Well, so this is like a seed round. You probably have no marketing there, but let's say your A would be a 10 to 30 million. Then you have more room for your other headcount. So I have there's a chart that actually maps it by stage. I think it's like David Sachs or. So it gives you the by stage, like what kind of org chart you should be aspiring to. So Series A, 50 employees. This is kind of like the headcount that you should have. Series B, 125. So you kind of map it for like what you expect to pay them on average and all that. And, like you're not going to vary very far based on like the big moving factors are the type of people you want to run, right? If you want to run a significantly different type of business, then you're making a decision. Okay, I want to do the same level output on 20 people. Which of these are you cutting, or which of these jobs are you combining into one job? Right. It's a fun question. Chad, what's up?
Yeah, so it's kind of interesting that you brought up the headcount question. Like, so you go through, well, you haven't gone through all of the information, but you get as much as the information about the company as you can. You decide that you're going to bet on this company in career-wise. How do you think about your compensation as an individual engineer with the information that you have?
Earlier stage, you care more about percentages, and later stage, you care more about dollars. Because the closer you are to an IPO, the more real money it is. Compensation. There's a lot of compensation questions here. There's a lot of stuff that's written. So there's cash plus equity, right? The cash amount. One mistake and this kind of maps out to total comp, but this is a very vague number. The more equity you receive, right? So let's say you receive a total comp. So like 50 plus 150 is very different from 150 plus 50. Does that make sense?
Yeah, especially kind of.
So and if you experience something like I did, where your equity does a 10x, this means that your 50 plus 150 becomes 1.5 million. And so that works out to 1.5 million. And then this 150. So you receive cash, you took less risk, becomes 650, right? So it's very much like how much of an equity owner do you want to be, versus a lot of people always tell you to value equity as 0, but that's probably not true if you're joining like a startup that is not like half-baked. One of the ways you can tell that is like, the quality of the investors, because they have a lot at stake as well, and they also have a lot of network to bail you out in case the startup ends up not doing well. Not to say that they don't have zeros, but they have a lot of outs, to use the poker terminology.
So just a quick question about the 50 plus 150, or just those numbers. So 50 would be your base salary, and 150 would be.
That's not realistic. Yeah. Let's say 100, 100 plus 100. Yeah, this is more realistic. Sorry. I just want to give you more realistic numbers. Nobody gets 50. Nobody in the US gets 50K a year. At least for software. Yeah.
Okay, thanks so much.
Yeah, you're welcome. Okay, I'll cover a few last things. I realized we actually went past the hour already, but I'm almost done. So the main thing to understand for churn is, there's an equation to convert churn to churn plus ARR to lifetime value of a customer. So this is very common ratio that I think people are discovering, Max is discovering, is not that useful, because we can mostly tell what an LTV is. So let's say what is the rough idea for this? Let's say our churn is let's say we make like 5K a year, and we divide by 0.5, and then it's like I don't know, 10. Wait, really? Oh, 0.05. So a very, very naive calculation LTV, looks something like that, right? Like the average customer that we gain has $5,000 a year that we expect. Each year they have a 5% chance of churning. Let's just say annual churn, which means that on average they have $100,000 of lifetime value. Some of them will be less, some of them will be more, but they'll average out to have $100,000 lifetime value. This is not how most people actually calculate churn, calculate LTV. Usually they want to have a cap. So because I did 1 over 5% on this annual churn, that actually means a 20-year life on this customer, which nobody calculates that. So they have a cap on customer life of, like, let's say 5 years. Right, so that will significantly and artificially reduce the LTV, let's say down to, like, I don't know, 60, whatever. But like just to make it more realistic, that's the easy part. The hard part is calculating CAC, customer acquisition cost. This is an attribution of marketing, and this is an unsolved problem. People with a few thousand employees can't solve it. There's no chance that a startup with 10 employees can solve it. So I don't think this is super useful. But it's a good math if you can have it, because that means that if you have positive LTV to CAC, you should just spend as much on marketing as possible, because every single customer that you add adds to your bottom line, right? Because this is the equivalent of, like, if you took this income statement and you reduced it to one person, to one customer, like the amount of revenue that you're getting from the customer and the amount that you're spending on that customer. That's the LTV to CAC ratio. Also does assume that you have relatively fixed costs, such that you have good. So assumes good margins. But otherwise, this is kind of the major moving parts. So I would say, like, this is kind of a little bit falling out of favor. The other thing that you pretty much want to pay attention to is payback period, which is a cash accounting concept. So the problem with this is that you're often paying the marketing cost upfront, like now, but you're only getting LTV over time. So this runs into the problem when you try to pour everything into marketing now, because you're going to run out of money. So you want the payback period to be reasonable in order to get more money, so you can pay it back. And especially if your LTV is backloaded. So this 100K may not be 5K every year for 20 years. It may start out as 1K, then 2K, then 3K, then 4K, then 5K, and then 6K, 7K. So it may be back-end loaded because of natural growth, right? Because of negative churn. So there's a lot of calculation in here that is kind of vague and fuzzy, but maybe payback period is the more economic one because cash is king. Like you need to just not run out of cash. And this is in the sort of LTV to CAC calculation. It's too easy to ignore when cash comes in and when cash goes out. Yeah, max is impossible. I will say like a very simple, total spend on marketing thing divided by net new customers in that period. Something like that. There's a high level CAC and then there's sort of attributed CAC per channel. And that can get, obviously you can go endlessly deep in this topic. And I just frankly don't have the knowledge. All right, let's talk about the last thing and then we'll go, which is valuation. Valuation typically done as a percentage of as a ratio to sales. So what's a good public market valuation? Does anyone know? And I'm talking about like price to sales or price to earnings.
25 is the normal, right? Like 25
so sales or earnings?
Sales, I think. No, earnings. It should be earnings, right? That 25x earnings.
All right. S&P PE ratio.
That varies number, but I think all SaaSes are at 40% now. Just why they're getting a price haircut.
What do you mean? What do you mean percent? What do you mean percent?
25.
So the S&P as a whole, this includes non-tech businesses. So this, let's just say like the industry average PE ratio, Harvard is at around 15, right? So S&P 15x PE ratio. For the data set on SaaS, I think there's like IBP, SaaS. How do I know this shit? I spent too much time in this. Okay, so they have an average revenue multiple. So let's say BVP Cloud Index 10x sales, right? But they also have earnings in here. Oh, there we go. Wow, they don't even have earnings multiples because all these are negative earnings. So yeah, so there's no PE ratio for SaaS because all of them don't make any money at all. Yeah, so I think that gives you an idea. But then, then the advanced question is, okay, what is Series A, B, C, D typical ratios, right? So A is kind of like this. Because often they may be pre-sales or the sales is so small as to not be meaningful. B, you can have something like, so this is like good times valuations, let's say 100x to 250x. And I've seen this go up to 2,500x before. This is how crazy things were last year in November. I don't have any way to explain this apart from people were very positive. And then it goes down to maybe like 40 to 50x here. And then it goes down to 30 to 40 and basically converges on whatever the public multiple is. And these are all sales multiples. It converges on what public multiples is the closer they are to IPO. So in other words, there's a lot of money speculating that they will get to IPO and they're giving you advance credit for that. Like ideally the multiple should stay the same the entire way throughout, right? But it's not because early stage is very competitive and people are placing bets. They're not valuing you as a multiple of sales. They're valuing you as a percentage probability that you will get to that sales. Okay. Yeah, that's it. That's my finance for developers in 1 hour. Hey, we did it.
Oh, we missed one.
It was intense.
Cash flow.
Cash flow. Raise more money. What are you talking about? And we talked about runway and burn. I mean, this is kind of it.
Yeah.
So I'll tell you, I've been talking with one founder recently. There are a few scenarios that I'll give you like 3 realistic scenarios. I'm going to anonymize these companies. Company A, but these are all real examples that I'm talking to them right now. B, company C. This one, let's just say 4 years raised. Let's say they have $150 million in the bank. Years of runway, $2 million a year, $2 million a month of employee costs, and 4 years of runway. So that calculates, I think it's like 2 times 12. That's 24 a year. Oh, okay, 24 a year times 4. Okay, that's 96. So they have $100 million in the bank. So this is what growth rate is these guys doing? Their growth rate is let's just say something to the order of 700 to 800% a year. That's the kind of stage that they're at. And then these guys, 1 year, 20 million in bank, employees, 30 employees. 300%. This is a less. This is like an earlier stage business. Okay, I'll just put this. Series B. These are all sort of realistic scenarios that I had to consider recently when I was joining these companies. Series C, or this is 9 years of runway, which is amazing. 17 million in bank, 43. I know all these off the top of my head because I just finished interviewing with all of them. Let's just say, I think they have something like 20% month-over-month. So you get all these like numbers thrown at you that you have to convert back and forth, right? What is 20% month-over-month? That is 1.2 to the power of 12 minus 1. So that is, yeah, that's also 7 to 8x a year. Is that right? Can anyone check my math? So yeah, that's roughly what we're talking about here in terms of sort of realistic numbers. And then you have to kind of make decisions when you're in a sort of startup environment between companies like this. This doesn't seem as good of a business, but they're about to get a lot more runway, right? So they'll tell you things like about to get a B, which means that this one is about to go up, and then this one is about to go up, right? The question is, can this go up in order to do that? So sometimes the growth accelerates because of the B, sometimes it accelerates before the B. It really depends on how you want to structure the fundraising around. There's no real standards around that. Obviously, you try to raise when you don't need the money, but sometimes, especially if you're running this number down, you don't have a choice. Cool.
Oh, sorry, go ahead.
Yeah. I'm done. Question.
So quick question. How does the kind of, the news has been kind of, fire and brimstone within the last week. How does that affect like all of your decision making around kind of this environment?
I told you cash is king, right? So 9-year runway, that's very good. They can survive a cycle. How long does a recession take? It can take 1 year, it can take 2 years. Like tech is not going away, right? Like unless like a short-term recession should not bias you in any way because you're hoping to build like a 20, 30, 40-year long career, right? So you need to be longer term than just reacting to whatever the latest headline was. Obviously, it does affect the valuation you can get in terms of the fundraising environment. Where's the valuation stuff? Here. It affects the public comparables. Therefore, it starts to trickle in down to all these numbers. But beyond that, like you're still figuring out like what is the best mix of career growth factors, like product enjoyment, team enjoyment, whatever, right? Like there's a lot of other quality of life decisions that go into a job that have nothing to do with are you an investor in a company or not, which you are, as an employee, but maybe less so.
Thanks. By the way, this has been absolutely amazing. Like, thank you so much for all of this.
I was going to do this at some point. I just I didn't know when to do this because I didn't know how long it would take, but like, it sounds like it takes an hour. So that's not too bad. Yeah, cool. And thanks for being a very thankful audience. And if you have any follow-up questions, let's talk in Discord.
Thanks, it was really great. Thank you very much.
Yeah,
we learned a lot.
Thanks for giving me the questions. I said nothing about career letters, so maybe we'll try that for next week, or we'll go to business models where we'll talk more about strategy, tech strategy of like how you think about these things. Because like the numbers are downstream of the strategy. So always try to remind people what the most important thing is. Anyway, it's been an hour. You have the full links and all that. And I'll see you next week. Bye.
Thanks. Ciao.
Awesome, thank you.
So I was gonna play the Windows down sound. I have to do this. Because I have my soundboard back.
Otherwise, we cannot leave. We just stay until
we
we
leave. Exactly. All right.
Yes.
And I'll applaud for
Now
myself.
safe to turn off your computer.
Oh, we need that blue screen. All right. Bye, everyone.